Yeah, thanks everyone for joining today. Srini has agreed to present on annuities. Over to you, Srini.
Yeah, so before I start, I just wanted to understand all of you here are savvy financial investors, right? We don't need to go over what are the shortcomings in most retirement plannings, and so many people do not even plan for retirement.
Yeah, no, I mean, if you have some standard slides, we can go through it quickly.
Okay, let me share my screen. Probably the basics I'll go through very quickly, and then we
Yeah,
can concentrate and deep dive on more on the annuities part.
okay.
Okay. Thanks everyone for joining. So I quickly wanted to go over, um, some of the basics. So when we are looking for retirement planning, right? So one is we are looking at growth. The even more important thing that we are looking for is safety, right? Because we saw in 2007, whatever many people thought they had a large nest egg, and because of the market fluctuation and loss in the portfolio, uh, like people had to kind of restart working or get other plans or change in their plans and all that stuff, right? So that is very important. And also longevity, right? We want sustained growth in whatever we are investing in. So give me 1 second, guys. Yeah. So annuities, it is like creating your own pension plan, right? And when I say that, many people may have some reservations, but we'll come to it a little bit later, right? So I don't want to go into all these basic things, but I'll just give an annuity for people who are very new to annuities. So basically there are two ways of creating an annuity, right? So in annuity you can either deposit a large bulk sum of money, or you can pay in installments or a period of time. But in return, right, you are having a contract with the insurance company. So in return, what you are saying is either you are getting a lump sum with some growth, or you are getting like a fixed amount of income generation during your retirement time. So what kind of money can you invest into annuity? You can invest both qualified and non-qualified money, right? uh, Generally what you see with annuities is you have the annuity where you either pay the money for an x amount of years, or when you make a bulk investment also, they will tell you that, hey, we are going to hold the money for x number of years, usually like 5, 7, or 10. That's what I've seen usually, right? There are also some things known as immediate annuities, but let's not get into that because that's used by only very very few people who are like, they like someone who has a large nest egg. Let's say you come out of your 401k and you have a large nest egg and you don't want to kind of play around in the stock market, so you can take out that and just put it into an immediate annuity and start collecting monthly or yearly payments. So again, right, so when we are in the retirement, what are the main sources of our income? It is social security, which we hope it will be still there by the time we go to our retirement. The second thing is pensions, which probably is non-existent in many companies. There are very few companies which are still giving pensions. And then last but not least, your personal savings. When I say personal savings, I'm also including 401k in that, right? So these are the basic sources of your income. And social security, like I said, right, I mean, we are the expectation is that it's going to go down quite a bit by the time we retire, if not totally non-existent. So like I said earlier, you can invest different kinds of funds. You can put different kinds of funds into your into your annuity. Number one is, you can kind of take your old 401k, roll it over here. That is the bulk, right? So all kinds of IRAs you can be rolled over here. Again, that we are looking at a bulk investment there. And again, this is inheritance through qualified plan. All of these things are the same things, right? Like you can get qualified money in various ways, and you can invest that into the annuity.
So
Non-qualified,
what,
you
what do
can.
you mean by qualified here?
Oh, qualified is that these are all like retirement. These are all pre-tax money, right? So you're putting money into like a retirement plan. So you would not have paid the taxes. So this is a tax later strategy, right? That is qualified money.
Yeah, but you have also put Roth IRA, which is after tax.
Roth IRA. I mean, I think these guys, what they mean is there are, I mean, I think it's a mistake that they have done here, Roth. But basically, it's also put there because many people, what they're doing is they're also doing backdoor Roth, if you know what I'm saying, right?
Yeah,
So what they do is, it is still qualified money, right? It is the source is 401k, but what you do is you convert it into a Roth IRA. You kind of give up the taxes right there, but then on the gains you can still pay do tax deferred by putting it into a uh, annuity, right? So you can put the money into an annuity and then take the money later, and you're again paying only taxes on the gains and not on the principal because you already paid the money there. That's what I mean. Okay, and non-qualified money, I mean, whatever you have, various ways you can invest that qualified non-qualified money, and also sometimes people take the whatever they get as the cash value from that life insurance, and that you can roll it over here again. So I'm just going to skip over this because basically what I'm trying to say here is that if you are trying to roll over, right, you have multiple options. One is generally what people do is roll over into their new employer plan, right? So some people like me, I think I have left it in my old 401k because of the uh, institution that my money was with and their option, the choice of the funds. But generally, people what I've seen is they roll it over into their current employer plan, or you can create like a self-directed IRA, right? Or you can withdraw it. So in all these situations, right, there is no downside protection. That's what I wanted to kind of the most important thing here. And we are subject to market aberrations, right? If the market goes down, no matter which funds you have put it in, it either goes down a lot or goes down a little bit, but certainly goes down, right? Unless you are in some bonds or something like that, right? And going over here, so we have seen that there are market corrections on an average, like about 5 to 6 years. There has been a market correction. The only exception to this has been the last 10, 12 years. Once the financial crash happened, we are being in an unprecedented bull market, right? So but that is not going to be sustained. So it's certainly going to be, there will be a correction. There may be a brief correction, there may be a longer correction, we never know. So let us the what I'm trying to say is that if you're putting money into a regular market, it is subject to market risk. And this is all over the last few years how the market has been performing. So sometimes when you have, like, let us say there is a large decline, for you to recover the money, like for example, let's say you have 100,000, market falls like 40% and you go to 60,000. So if you want to get back to where you were, if the market grows back again in 40%, you're not going to go back to 100,000. So it takes a longer time for you to recover where you were. That's the point I was trying to make. uh yeah, so when I say annuities, a lot of people, or when you read, generally go into Google and read about annuities, the things that people don't like about annuities is, number one, there is not much growth. Usually the returns is like about 3 4% or 5%. That's what I've seen in majority of the old time annuities. The second thing is there are a lot of fees involved. The third thing is what they say is, hey, you have to leave the money in for a certain period of time, and you may not have access to those funds. If you try to withdraw the money before that, there may be some fee that they charge, the institution charges. So that's why people do not like annuities. But off late, the insurance companies have come up with some creative products and trying to attract people back into annuities, right? So this is where I wanted to go over the indexed annuities. So indexed annuities, majority of them that I've seen is where you put in like a lump sum investment, and let's say you put in like 100,000 or 200,000. roll over your old 401k, whatever, right? What they say is, hey, you know what? We are not just going to give you like a fixed amount of interest. We can tag that to to an index. So the advantage of that is, all of us who invest in the stocks, we like the stocks because we are getting a higher rate of return compared to any other avenue. So what these insurance companies are saying is, hey, we will give you a bunch of indexes or indices, right? And then you can peg your money to any of these indices or a combination of them to diversify. And then in return, what we are also giving is they're giving you a down market protection. This is very important because what they are saying is no matter what happens to the market, like let's say the market goes down 30%, you don't have to worry about your principal because we are going to give you a floor of zero, or some companies also give you a higher floor. They'll give you like a floor of 1%. So that means the minimum return that you get is anywhere between 0 to 1% on any year, right? That is very important in a year like 2007 or whatever, when markets retreated like about 30-40%. Being being level and not losing any money is a blessing in such a scenario. The other thing they are giving you is they're also giving you an option for people, like when you're planning for retirement, you're always thinking, and many financial advisors say, hey, you have to think about how much money you need during retirement. Not many people think about it. Even I had not thought about it many years ago, but once I started understanding, now I think about, okay, if I have to live in the same way that I'm living today, same standard of living, how much money would I need? So you factor in inflation and all those things, then you come up with some number, right? So that number, at least you want to make sure you're getting it from somewhere, right? Somewhere where you can, where it is guaranteed, where you don't have to think about, will I have that money or not, right? So that is very important. So the annuities are also kind of giving you those options, saying that, hey, we will give you X amount, and they try to predict based on how much money you're putting and all that stuff. And flexibility. So annuities have also started saying that, hey, yes, you don't have you we want you to kind of park your money for a fixed amount of time. But what companies are also saying is that, hey, we'll give you, like, for example, we'll give you, like, you can withdraw 10% of your money every year if you want, up to 10%, right? So like, let's say in year number 2 you can go and withdraw 20%, up to 20%, and so on. And like I said, the principal is not getting depleted here. So, what are some of the companies that are giving annuities, like these new kind of annuities? The number one company in US is Athene. Number two is Alliance. So these two companies have been going back and forth between play number one and number two. And then you might have heard about Corebridge is nothing but AIG. You must have heard about North American Mutual. There is Fidelity and Guarantee, and Nationwide. These are some of the prominent companies. There are, of course, other annuities and other companies giving annuities, but these are some something in the top 10 that I have picked. Any questions so far?
Yeah, I mean, I think I did look at annuities several times in the past, but always decided against it because of excessive fees, right?
Mhm.
So,
Okay,
yeah, there are two negatives, probably more, but two major negatives are, one is fees, and the other is surrender value, or not, yeah, you are locked down, right? So you cannot
correct.
change your mind. Yeah,
Correct.
those two are major disadvantages, because annuities are still being sold by agents and so on, right? They have to make a living, so there is commission, heavy commission. Like
Yeah, I mean, but
some
that's
of
why, I mean,
those
you got to. Yeah,
some
sorry,
of
why
those
don't.
12B, or sorry, before 12, mutual fund loads, 5% first year, and the similar thing I have found. I have not looked at annuities probably recently, but the fees were always heavy, and also you are locked down in the money, and you cannot, and also it depends ultimately. how healthy you are and how long you are going to live, right? So
Yeah. So I think all the things that you mentioned are absolutely true, and some of them have been addressed in the new era annuities. And when you talked about agents, yeah, I think you need to go to a good agent, right? So who is financially, I mean, who is vested in your interest? That is where people make a difference, right? For example, when people come to me, I will never recommend anything to them where I would myself personally not invest. Like many of these things that I'm telling you, I have personally invested, right? So I think that is very important, that you don't go to a specific company agent, right? Like for example, if you go to an Athene agent, he will say Athene is the best, right? Or if you go into an FNG, he'll say, hey, my company is the best. So you want to go to someone who has a neutral attitude, and who's giving you the reasoning, right? So I'll show you one of the examples, and I think you will understand more on what I'm trying to tell you on how you do the research. The other thing I wanted to tell you is surrender charges are still there, right? But companies are saying, like, every year you can withdraw like 10%. So that gives you access. The third thing is, I mean, it also depends on why you are investing in an annuity, right? For example, if I'm investing in an annuity because I want to make sure I can get like a steady stream of income when I'm retired, right? So when I'm retired, I want to make sure uh, it meets my goal, whatever is the number coming out meets my goal. Once I have that secured, then I can go and play around with whatever else, right? I mean, you can still go and invest in stocks and everything, but you're not under so much tension that you don't know what is going to happen to your nest egg, compared to when you have already made plans for your retirement, right?
Right. Srini, this is Madhu.
Hey,
Um,
mother.
in addition to the points mentioned by Nari, I think one more point is when you withdraw,
Uh-huh.
is it tax exempted or some?
So
Yeah.
there is no one answer for that, right? I will say the answer for that is the depends on the funds you are using for funding the annuity. Like for example, let us say you are rolling over your 401k. So just like how let's say you put your 401k and roll it into some funds, you're still not taxed, right? It is tax deferred, and you pay the tax only during withdrawal. So the same thing is here in the annuity also. Let us say you put post tax money. Let's say you put your personal money, or you put like some Roth funds into it, then it is tax deferred till your withdrawal, right? So when you're withdrawing, you're paying taxes on your growth. But what I would say is, like, let us
Yeah,
say I had invested
they
100,000.
say there is some provision called as 77, Rule 77, which exempts you from paying tax on what you withdraw from the annuity.
From an annuity.
Yeah.
Not in a straightforward way, no.
Uh-huh.
Because like let us say you are putting in post tax money, the growth is charged, but the only thing is, if you are it depends on how much you're withdrawing, right? Like for example, let's say my 100,000 becomes like 500,000, right? So 400,000 is my gain. So if I'm withdrawing all 400,000 in one shot, we are liable for paying the tax. But the beauty of the annuity is, what I can do is, I don't need to withdraw the whole money. I can leave it in the annuity, right, and allow it to grow the same way, right, or with the downside protected, and I can only withdraw the amount of money that I need.
Yeah.
Right?
Hey, hey, Srini, this is Arvind. Uh,
Yeah, Arvind.
I first, I on the slide you said 5% rule, so I don't know if you can explain that particular piece because I did not get that 5% rule in the point number 7 principle not
Uh,
depleted. So that's
there are some companies, what they say is, some companies are saying that
Mhm.
they will kind of protect you up to 5. They will only go negative 5% sometimes, right?
Okay. Okay.
So that's
So
what they are talking about.
so at least your 95% of your capital is protected, right?
Correct, and this depends on
Approximately.
some on the
Okay.
company, right? There are so many annuities that I've seen where the floor is still zero, so then you're
Right.
not then you're not. And then they also have to disclose this, because, like, let us say the market has been negative throughout, right? All, like, let's say you are in a 7-year annuity and it has been negative throughout, which usually doesn't happen, right? So then what is happening? Your 100,000 remains 100,000, right?
Right.
Because you're not getting any return, but at the same time you're not losing money. But
You're
then
losing.
there are certain
Sorry, inflation you are not taking into account, right? Because you're definitely losing money because of inflation.
Right.
yeah, I mean, what I'm trying to say is your principal you're not losing. That's what we are talking about here. Principal not depleted.
Right.
The value of that money is certainly lesser than what you invested.
Right.
That is there. That is the future value, right? But
Right.
I'm just talking about, let us say it is negative all the years. Then there will be some fees and other things that, that is, that might be taken from that. So that is why they say, hey, you no more than 5% is what some insurance companies say. But
Right.
the annuities that I'm going to recommend, right, will not even have this. But I'm just giving you a general
Yeah.
view of what you will see with a fixed indexed annuities.
Right. So one quick question, and this is again, I'm thinking simple about if I am the business running this annuity business, how am I going to make money? So if I am protected on the downside for even if I'm losing the inflation value, I guess principal is protected. Yet on the upside, you mentioned that I will get the growth of an index fund. So SPY or any index fund I choose, I will get the growth. So how a company is making that downside protection without asking me something in the return, maybe from growth or maybe in the fees?
Yeah, good question, right? So basically what they're doing is they're not taking your money and investing it in the fund that you're pegging it against. Right? Like, let's say you say S&P fund. They're not taking your money and investing it in S&P fund.
Okay.
They're taking your money and, so let us say you invest in a 10-year annuity. I know your money is with me for 10 years, right? Guaranteed. So me as a company, I'll go and invest it in some other, commercial ventures, which can give more return than the stock market.
Okay.
I mean, I myself have invested in, real estate syndicates and other syndications and other things, which, have guaranteed more than 15%. So I would not be investing it in the stock market and risking it, but that is what all these insurance companies do, right? All this life insurance and all the other companies, basically they are taking your money and parking it somewhere else, or they're giving you loans on commercial ventures where they're going to make, big double-digit growth. And in return, what they're giving you is they're pegging it against an index because they need some basis to give you the money, right? Otherwise, then there is no basis and predictability.
Right.
So by pegging it to an
Actually,
index,
there are two issues, right? So when there is higher return, there is always higher risk. So that means, if there is they invested in a lot of commercial real estate or something, and if that tanks, right, and then you have the potential of the company going bust as well, and there is no FDIC for annuities.
do you know of any insurance company that has gone bust except for that AIG during the, the housing this thing, and that too it was for a different reason, not because they made this, not because they ran out of money, right?
My understanding is, I don't think. I mean, there may be some companies who are doing like taking your money and risking it, but my understanding is they will deduct some thing. I mean, they will not show you the calculations, but basically, suppose if your fund is reliant on SPY, right? So they will still put they will not guarantee the full SPY. They will say that.
Correct. That's what I was coming to, right? I mean, that is what I'm saying.
Reduce the guarantee.
Absolutely.
And the other thing is they will buy some insurance wholesale in case SPY tanks, right? There can be like protective put and so many like options. Other protective options are there.
They can do all of that, right?
So they are correct. They will do the insurance on without telling you. That is how they are able to guarantee that your money is safe, and because they are doing the insurance.
No, so Nari, basically there are two kinds of things, right? I mean, let us not confuse there. I will certainly answer your question. But where they are investing, I mean, it is not disclosed, right? They are going to invest in wherever, whether it is some other venture. I'm sure they are going to look at the risk versus reward and all that stuff, and that is one thing. The second thing is, this is a regulated product, right? This is not an unregulated product. So for life insurance, I know the state and the insurance organization recommends that they need to take secondary insurance. Like, for example, for any life insurance company, if they have like $1 billion in assets, they need to take $1 billion secondary insurance, or more than that, like 1.5 billion in secondary insurance. That is there for life insurance. But for annuities, I don't know if that is mandated, right? But that being said, what you said is also true on the indexes, right? So if you look at, and I want to show this with I think I want to show an example, and then people may understand better, right? But before I go there, I wanted to show, before I go into the actual uh, illustration of one of the for one of the annuities, I wanted to show something else, right? So successful investing and tax strategies, right? So basically, what we do is, generally when we are putting money into 401k, we are kind of like, let us say we are putting like 10,000 per year for 25 years, we would have contributed 250, right? So if you assume like 6% growth, your accumulation is, and it goes into 581, right? But what happens is, if it is 401k, then you are withdrawing this money, or you're subjecting this to market risk if you do not withdraw after your retirement. But what comes with annuity and some things like fixed index life insurance and all these strategies, you are not just getting the money lump sum like this at that point of time. If you go for a distribution, you can get income over a period of 20-25 years defined by you, and then your overall distribution can be as high as $1 million. And I'm going to show you that exactly. And Nari, please hold your questions. I'm going to, when I show the example, I think we can talk specifics, right? Because I'm going to show how some companies are kind of adding the caps, like
Yeah,
how
I
you
think
said,
I think
participation rates
example
and
will
everything.
help, because we
Yeah,
should hold on for some time our questions, I think, and till we complete that example and all that, then we'll be more clear, I think.
yeah. Let me share my screen on a couple of examples. I wanted to show you two main kinds of annuities that are out there, which I like, right? I will first start off with an accumulation annuity, which is pretty straightforward, right? We are putting in some money as a bulk. So like, are you guys able to see?
Yes.
Okay. Yeah, so I'm showing you from a company called Alliance, right? Like I told you, Alliance is either 1 or 2 for the last 10 years. So again, making sure that these are all rated very high. This is all very important for us where we are investing, right? That is one thing you have to look at. I'm just going to pass off all these things, and I can send you these illustrations to people who are interested, and they can take a look at it. So let us look at this, right? So these are the indexes that Alliance is offering for an accumulation uh, annuity, right? So I've just put 10% to diversify. But if you see, right, there is a Bloomberg US multi-year point-to-point with participation rate, and this is a 2-year index. So what this means is, I just want to tell you, this is a index which has been prepared for the sake of annuities and life insurance companies by these companies like Bloomberg and PIMCO. So what they do is, they say, the insurance companies will come and tell them, hey, this is like a target percentage that I'm looking at. Can you design an index for me? And they will design an index and give it to you. So, but these are, you can go into Google and look at their performance, and also they'll give you the historical performance as part of the illustration. But this is available for to kind of make sure that the index is not very volatile. They control the volatility by the holdings. So that's what they're trying to do here. So usually, I mean, no matter what insurance companies say, what I tell everyone is that you think about that you're only getting 6% per year. Anything that you get above that is a bonus, right? But if I get 6% without having a down scenario, right? I mean, even if you look at 401k, generally what experts say is that, hey, expect like a 6 to 7% return over a period of your work tenure. So but then that 6 to 7% is an average, because there are so many years you're losing portfolio value, and there are so many years you're getting double digit growth or whatever. So overall average, they're saying you're getting 6 to 7%. But if I can get that 6 to 7%, right, without having to worry about market aberrations, then that is a bonus for me, right? So that is what they're aiming for. And then if you look at this participation rates, right, what it means is, like, let's say this returns 10%, they're going to give me 290% of that. So I'm going to get 29%. But like I said, they would have made the volatility to about 5%. Okay. So similarly, they have a year to year indexes, right, where they're looking at the point to point annual index, where they look at the beginning of your contract year and the end of the contract year, and whatever is the growth, they will give it to you, or if you lose money, then they'll leave it at zero, right? So here is an example of S&P monthly sum, right? So here again, they're looking at the beginning of the month and the end of the month, but then they're capping it to only 3%. Okay, and there is also like a fixed strategy, current rate being 4.75. So these are some examples of what you can get from an index perspective. This is what Alliance is offering, right? So there may be a lot of other things. So then let us go into the actual illustration. So if you look at this, let's skip this guaranteed values. This is just a regulated thing that they have to show. So here is what they're showing, and this is based on the last 10 years, what happened, right? So they are saying that, this is like if you look at the interest rates they're showing here, it is they got a return of 5% here, 13%, 0.45. So they're just trying to mimic the last 10 years. And if you see, that repeats. Once you see the 10 years, they're repeating the same thing. So if you're investing 100,000, so let us look at this, right? At the end of year number 1, you are getting 104. But then if you look at this guaranteed, they're showing only 88. The reason is because this is a 10-year annuity, and if you withdraw money in the first year, they're going to remove surrender charges, right? So similarly, if you're if you're looking at this and I'm saying I want to keep the annuity till I'm retiring, so you see this here, your money has grown to this much. And then you can withdraw the money, right? So here basically this annuity is designed for the focus on accumulation. That means they're not going to think about giving you a guaranteed income or income stream, but what they're doing is they're going to just give you the interest accumulation yearly basis. And so when the contract expires, you can take that money in a lump sum or leave it there for some more time to accumulate interest, right? Any questions on this one? No questions?
I was supposed to get there at 7. I got there at like 7:25. Because Dad is asking me these two things to say all that is saying. I was talking to him about it.
Nari, am I audible?
Yeah, you asked me not to ask questions.
No.
What is the
I said let's hold
guarantee?
it till the end. So now that I have shown one annuity, yeah, please go ahead and ask your questions. I'll show you one more after this. But so
What,
far, if you have any questions on this annuity, please go
what
ahead
is
and
the
ask.
last column? Guaranteed
Yeah, let
value?
me share it again because I was not sure whether I lost you guys or not because I didn't hear anyone.
What is the last column on the table?
Yeah, let me show you. Yeah, this is the guaranteed value. So what the guaranteed value means is, like, let us say there was nothing that that you got a 0% return, right? So they're collecting the fees and surrender charges if you quit in that year.
So it is so low compared to the end of the year pre-market value, cash value.
So don't look at this pre-MVA cash value. I think you should look at this one. This is what we want, end of the year accumulation value.
Yeah. So,
They have to show it by regulation, right? What happens if you exit and there was no return? So this is what you get.
but if there was return and you exit, then it will be a lot more than.
Correct. That's why they say minimum, right? This is the minimum
Can
guaranteed.
you scroll down to see the notation? What is the number 3? What does it say? Number 3, number 2. Number 3, you would receive your contract guaranteed minimum only if it were higher than.
Okay.
This is.
So, I mean, I can explain this in detail, but let's not get into those technical things, which is inconsequential here. But what we are trying to see here is, what happens if you continue in the annuity and you are getting this return. This is what you get.
So
If you do not,
what is pre-MVA cash value?
yeah. So that is again, if you want to exit, so they look at a market value adjustment. Okay. So the market value adjustment is like, if you're exiting, they're going to kind of, like, let's say you exit in the middle of the year, right? So then they're going to do a market value adjustment. So that is what they're talking about. So that's why I'm saying let's not get into those technical details at this point of time. Let us concentrate on the basics, and then we can go into all those details and I can explain those to you. So this is the accumulation annuity. And one of the things I wanted to bring up is, people may have this thing saying that, hey, let's say I peg this to an index. Let's talk about the Bloomberg index, right? So normally it is saying point to point and 2-year, right? That means they'll take year number 1, first day of the contract. Let's say the index value was 100. Then you go into the year number 2, end of the contract, and let's say it was 115. Then you have 15% return, right? But what if you are in a declining trend and you go into 2 years and then you did not and then the index value went down? So you're actually going to get 0, right, for that 2 years. So which is very bad. So what Allianz offers, and this is very unique, is something known as index locking. So what they say is, you can track this index. For example, I have invested my money into this. I can watch it every day, right? And let us say sometime in this 2 years, the the index has gone up. It's not that even when you are in a declining trend, it's not that the market will be constantly declining, right? So there will be corrections and it will come up. It may go down again. So, but because this is a point to point, they're looking at first day and last day. What you can do is, let's say in the middle of the year, it is like a 10% or something, and you say, hey, you know what? If I get 10% return during this time period, I'm happy, because there is a 290% participation rate. So that 10% will become 29. I can go and lock that index. So no matter what happens to the index, I'm guaranteed that return for that time period. So I feel this is like getting the best of both worlds, where I can still look at the index and control my returns to a certain extent, and I'm not just worried about the point A and point B returns.
Yeah, can you explain this 290% participation? I'm not clear.
So what they're saying is, they're saying whatever is the return of this index, right? They are going to multiply it by 290%. You're going to get 290% of it. So if it is 10% return, you're going to get 29% return actually. If the index went up by 10%, you're going to get 29%.
So does that actually add to your cash value at 29%?
Absolutely. One of my clients last year got 21% return.
I mean, just some information here around this, like Bloomberg index,
Mhm.
they have tabled the index in a particular manner. So normally it grows, it's about 35 to 40% of the normal index growth.
Yes.
So in other words, it's 1/3. And then,
SPI goes up by 10%, Bloomberg will grow by 3.5%.
yeah, that's right. That's
No,
right.
you're right. You're absolutely right. I mean, these indexes, see, I mean, this company doesn't want to just give you free money and unlimited amount of money, right? So they want to control the upside also. So that is where I'm saying, normally, if you look at this, yes, you do not get, but they're also protecting your downside, right? So if, for example, there is also an S&P this thing here, and even there they're saying, look at this, they're saying 5%. They control the volatility to about 5%. But what I'm saying is, like in this company, which is unique, which I have not seen any other insurance company offer, you can go and lock it. So and I'll also show you the historical changes for all of these indices, which is there down the line. So why don't I go there? Because okay, let's look at this, right? So if you see, sorry, yeah. So if you see this, there is 335%, right? Is the participation charge, and they're also giving you what is the high, what is the low, what is the annual credited rate. See this, they're saying high period they've credited 17%, low period 10%, average in the low period is 7%. So they've given you all these things, what they have credited in the last few years, right? So similarly, there is, for every index they've given you. And then you have this is PIMCO, right? So you have the option of going and locking it if you're tracking it. So these are all historical actuals. Right? See, all of them have decent returns. So I can share this with you, or you can go through in detail, and you can also ask me questions. But within we have just like about 10 minutes or something like that. So I want to quickly show you the income annuity also, so that you get an idea on what is there. Can you see the new annuity that I opened, or is it still showing the old one?
You can see the new one.
Okay. Okay. So this one is, I'm showing you Athene. I showed you one Alliance, so I'm just picking a different company. Where this is also again, like I said, top 1 and 2. So if you see this, right, these people have a little bit fewer options compared to Alliance. And then you see the participation rate here is 100%, 120, and 145. There is also like an 82% participation rate where you get lower than what this index gives you, right? This is the NASDAQ index. And then this is BNP Paribas, and this is AI powered US equity and S&P. These are the options they give you. And these are the participation rates, right? and then this, what is the current rate? So this 1 year S&P has a 6% cap, right? So what I usually recommend my clients to put in is in this BNP Paribas and AI powered. So let us look at, okay, this is again the historical performance they've given you, right? So look at the average returns is about 6-7% in Athene, right? And this is a average return when you go for a 2-year index. 2-year index will always give you a better than the 1 year for obvious reasons. So this goes into like again 8-9% is the average return. I'll skip the guaranteed one. This is just for regulation. They'll show. Okay, well, let's look at the non-guaranteed, right? So here, what the company is doing is, this is very interesting. Let us say I'm saying that for one of my clients, they had 120,000 that they are investing. They're rolling over from one of their IRA. So I wanted to show you something known as benefit base. So the intention of this annuity is to kind of make sure that they give you income during your retirement. This is not based on accumulation. So they're only encouraging you to keep the money with them for longer and collect an income from them, as you after you retire. That is the main intention of this. So, like I said, we are starting with 120, right? If you look at this, you see something known as benefit base here. You see the accumulated value. You know what the accumulated value is. We saw in the previous one also. There is a death benefit. There is a cash surrender value, right? Cash surrender value will be obviously lower because if you are leaving in, this is a 7-year annuity, right? If you leave before that, then you incur surrender charges. So let's assume we are continuing, right? But look at this benefit base. Right in year number 1, it shows 191,951. So what this is Athene says, hey, currently they're running a promotion. So what they're saying is, whatever money you deposit, I'm going to give you 38% bonus right on day 1. And that is guaranteed to be given to you. And that is what they're putting into something known as a benefit base. And this benefit base is only given to you if you stay with them and take the income they are giving. If you want to collect a lump sum money and walk away, then you get the accumulated value, which is equivalent to the cash surrender value after the 7-year period. So let us see how this is happening, right? This is a beautiful thing because right on day 1, I'm making a 38% return. So, and again, remember, this has a 0% floor. So no matter what happens, I'm at least guaranteed that 38%, right? So even if the portfolio grows by like 5 or 6% over a period of time on average, because of this 38% that has deposited, which is also growing along with my initially invested 120, my return in the end is very high, right? So, and I'm saying my client will start taking income from year number 59 because he wanted to retire at 59. But if you move this to later, you'll get even more money, right? So here is what is happening. So once you come to year number 59, you see that the benefit base is showing 654,000, whereas the cash surrender is showing 399, right? So they start paying you income every year. So they're giving you 25,000 in the first year and so on. It increases as you age. So if you see this shows the cumulative withdrawals. This is showing how much they're giving you. And they're giving you less because you started off early. Like let's say you had started at age 66 or 67, you would have seen a higher number. But you can see that this is increasing day by day, like year by year, sorry. Right? So once you see, as you go older into 80s and you see the returns are like 150,000 and all. But one thing I wanted to point to you is, the money that is being taken out is from the benefit base. But you see in year number 74, year number 75, your benefit base is 0. That means whatever money you had put in is all exhausted actually. Because if you see, your death benefit is also 0, cash surrender value is zero, everything is zero. But they continue to give you yearly income until you pass, right? Even if you assume that you're going to stay, you're going to live till 85, right? You're getting 150,000. So by then you would have already withdrawn 1.9 million.
What is the yearly income? Yes.
Yearly income is this. This is an increasing thing. So I started, like I said, I started at 59. So they started off like at 25,000 and it keeps increasing every year. And then until you pass. So here, if you add a joint annuitant, you can make sure that your wife will continue to get the annuity income.
How do you decide the yearly income? Oh, I don't
No,
understand that.
it's not. It's an algorithm they are doing it, right? So I don't know. There is some algorithm they use behind the scene, right?
So they will
So
send
it
you a
is a
check for that
percentage of your benefit base and all that stuff.
So they will send you a check for that money every year.
Absolutely. And it is also dependent on the return, right? So this can go higher if the returns are higher and lower if this returns are lower. But you're starting off at a benefit of 38%. Any questions?
Again,
A
going
couple
back.
of questions from my side. Can I speak?
Yeah, go ahead.
Somebody else, I think Wish was speaking. Wish, go ahead.
Just a Naris question about this company going bankrupt, then you won't get anything, or they're all reinsured and you'll get that yearly income.
So, like I said, right? I mean, they are all protected, right? And I have never seen any insurance company go bankrupt till now. So, chances of them going bankrupt is very, very less.
I think they must have taken FDIC protection up to
No,
90%.
the FDIC doesn't work here. FDIC doesn't protect
Okay.
any of these things.
I think they have their own regulations, right? Some insurance.
The insurance companies
regulations.
have their own regulatory authority, right? That is where the secondary insurance that Nari was talking about, right?
That was for only life insurance, I thought, not for annuity.
That is for life insurance, and that is where you are also going and seeing the rating of this company, right? You're going and you're investing only in A plus and higher, and these are all companies that have been existent for many decades.
So, Srini, the business that these companies have, the life insurance business is different from annuities business, correct?
Correct. And Athene does not have life insurance. Athene does only annuities.
Okay, but
Alliance does both annuities and life insurance.
But
Also, I don't think.
Yeah, when we are talking about the insurance for the life insurance policies, that does not apply to annuity, even though the company may be same, right?
Right.
That was my question. Okay, just because life insurance hasn't gone bankrupt doesn't mean this cannot go bankrupt. The annuity.
No, but if the company is soluble, why? What is the reason they'll not pay you? It's a contract, right?
Yeah. Also, I see they are not taking that much risk. Actually, the life insurance is taking much more risk compared to these because unless, of course, the market completely wherever they are invested goes down completely, but otherwise their risk is confined to because they are not like life insurance. Somebody can die, and they have to pay millions and billions, so they are already reinsured with somebody else. But here, I don't think they are taking that much risk.
Yeah,
They are trying to keep their indices. That's why to like about a 5 to 6% return, right?
Yeah, and I think what they do also is up to 90% they put it into bonds, and
Right.
that 10% they actively utilize it in options.
Right.
So for Alliance, they have an in-house, investment arm. So that investment arm actually works on maximizing the returns for them and for the customers. So they say very clearly that they charge a little bit more, but their returns also are, commensurate to that, right? So they have their own investment arm. Other companies, what I have seen is they outsource their investment strategy. Like, for example, they're going and asking Bloomberg to give their, to give an index, which they'll give their criteria saying that, hey, this is the kind of rates that we are targeting, and then they're going and getting it from them, right? But the companies like Alliance, they have their own investment arm.
Just in this example, just one quick question and I'll stop. The only investment they made was 120,000, or yearly they were
Correct.
putting some money.
No, there's nothing else. 120,000. See, you say it's based on a premium account of 120. That's it. There is nothing you invest after that.
Srini, one quick question.
Mhm.
Let's say you start in like age 46. So what does it mean? Like, how does it scale from there? You have to wait for 20 years to start withdrawing or getting those?
No. I mean, see, this is defined by me. So this I've done it for one of my clients who is 40 years old now, right? And who said that he wants to retire like around 60 years, right? So that's why I've done it this way. So, if you're 46, then the 46 will come here, and then you invest your money here, and then you can define when you want to take, right? So again, this is an illustration. Let's say I illustrate saying that you're going to take it at 60, but come 60, you may not want to take this thing, right? So you just send them a form, and then you say that, hey, I want my income to start from a different year, and then they will start your income from a different year.
Okay.
So when I'm writing this annuity, right, I'm not telling them when you're going to start taking your income. I'm only saying that, this is like a 10-year or 7-year annuity. Yeah, 10-year annuity, I think this is. Yes, 10-year annuity, right? So I'm only telling them, hey, this money will be contracted to you for 10 years. I'm not telling them anything else. So this lifetime income you can start whenever you want.
Just like for 401k, the earlier the withdrawal start, then your disbursements will be lower. Is that how it scales?
Exactly. See, my suggestion is, everyone, all of us are working somewhere. So we will, no matter what it is, we will invest in 401k, at least for the match we are getting from our companies, right? So we will have, whether the market went up or went down, whatever return it is, we'll have some money in our 401k. And as long as it is sitting in your 401k, it is always subject to market risk, unless you move your fund, your money into like a bond fund or something as you age and come closer to your retirement age, then it is subject to market risk, right? So, and then there is the RMD and all that stuff. So what I suggest to my clients generally is, why don't you first spend all the money that is there in your 401k first? And these things are all market protected, down market protected. So even if you leave it there, nothing is going to happen to it. And then start taking the income here. Then you will maximize your income, right?
Yeah, but when you roll over from your 401k to annuity, you are not subject to taxes?
For a rollover, you're not. But when you're withdrawing, of course, you have the same tax treatment as what you would have in 401k.
So how are they going to monitor your, like say, you roll over and then you are free to do whatever you like, because that's going by the,
No.
because
See,
sorry?
Sorry, go ahead. Why don't you finish your question?
Yeah, let me first finish. What I'm saying, in 401k, you're regulated by the 401k rules that, you cannot, you will be always have a minimum distribution starting from 70.5 or something. And then, you are, whenever you withdraw, you will be subject to taxes, distribution. So when you roll over to this annuities, then you go out of that rules, because you're saying you're not paying taxes right now. So, and
No,
you're,
I'm saying you'll be having the same exact rules as 401k.
but who is going to monitor that?
So this is an organization that is monitoring, right? Because
Okay.
when you're rolling over from that is why they say qualified. When I'm writing an application, I mention whether it is qualified funds or non-qualified.
Right.
So if it is qualified funds, they are going to report to IRS. They'll report to IRS no matter what, but they're going to report to IRS that these are qualified funds. And if you're not, let's say after 10 years, like you have invested 40, After 10 years, you are free to do whatever you want with this money, in the sense that you can roll it out of here to some other place, right? Or you can withdraw. If you withdraw, they're going to put the 10% penalty for you. You
So
cannot
are you
escape.
still going to be governed by minimum required distribution?
Absolutely. All those things still stand.
Okay, so these companies will be doing executing on based on
Correct.
that.
So they are
Okay.
called as the custodian. They will act as the custodian for the money.
Essentially, this is an IRA, period. That's it.
Yeah, this is a
Yes,
different.
this is an IRA if you're putting qualified money, right? I mean,
Yeah,
for
exactly.
example,
Right.
I have my own savings. In stock market, I invested in Tesla. I've made 200,000. I can bring and put that 200,000 here, and then it will be treated as non-qualified, right? Then when I'm withdrawing, it is not treated as an IRA.
So, Srini, one question I have on the withdrawals, what you get every year, from some other annuity, I got the impression that it is tax-free. It is provided under some form 774 or something like that. So
I really have to look into that. No,
yeah,
I mean,
can
I
you
don't
appreciate
see any.
if you could look into that?
Oh, I think I know what you're talking about. Yes, that is for life insurance. That's not for annuity.
Oh,
I know what you're talking about.
yeah, even I was confused with that.
Yeah, so basically, what life insurance that says that section 774 basically says, like, let's say you have life insurance money, and let's say you pass, and that money is given to your dependents. That money is 100% tax free. Your dependents do not have to pay taxes on it.
No,
That is the section 774.
I'm not referring to the money paid at the time of death. I'm referring to what you withdraw every year. Can you just research a little?
I will research and I'll let you
Yeah.
guys know. But as far
Yeah.
as I know, I know we talk about that section 774 when I'm talking about IULs, and I say, hey, this is one of the advantages which we should
Mhm.
leverage, and that's why I recommend IULs for
Yeah.
many people. But that's a different topic. But I will look at it again just to be
Yeah,
sure.
in
But I don't think,
FIUL.
yeah, but I don't think IRS will let go of any money just like that, right?
Actually, actually, this is very useful if we didn't have our social security benefits coming in, like no pension or anything. But since you are getting that, and it's at advanced, like I am already crossed some stage. I'm almost 75 now, so I don't know at that stage any benefit of considering annuities.
There is an immediate annuity. So immediate
Uh-huh.
annuity also has some. There are some immediate annuities where they're offering some bonus,
Can
right?
you give some
Yeah,
example
I'm
of
just
that?
listening to you.
I mean, I'm not prepared here. I have to run an illustration, but I'll leave my details with you. You can feel free to call me, and Nari also has my details, so feel free
Oh,
to call me and we can discuss that one on one.
okay.
Any other questions, guys?
Yeah, a couple of questions from my side.
Go ahead.
The initial money that one starts up, let's say in this example, 120.
Mm-hmm.
For before 10 years, the commitment period that you have, if let's say a person passes away,
Mm-hmm.
what's the impact?
Yeah, you see this here, right? So let us concentrate only on the first 10 years, right?
Yeah.
So first 10 years, if you see, the accumulated value is 136 here, right? Cash surrender is 125. That means if you are exiting on your own, they're going to withdraw the surrender charges. That's why this number is lesser than this number. But look at the death benefit. In case the annuitant passes away, whatever has accumulated, they'll give everything to the beneficiary. They're not going to hold a single dollar.
So in this example, 136, 429, that's the
Mhm. Yeah, that is the accumulated value. Whatever is accumulated, they're giving it to you. They're not going to give you benefit base because that they're building it to give you income.
I understand. No, there are two columns that have the same value. One is accumulated value column, same amount, and the same amount again shows up in the last column, which is the death benefit.
That's what I'm saying. Accumulated value is how much you have accumulated based on the interest that you got that year, right? So that is what is the account value. Death benefit is what if you pass away in that year, this money will come to you.
So
Okay.
surrender value
So
will
It's
not
not.
be there.
Surrender is
all these,
while you're still alive, if you feel like exiting, you would get 125. For having put in 120 to start with,
yes,
at the end of the year, you will get 125 if you want to just
correct,
exit out. Okay,
correct.
at any point. All right.
So
Now,
you see, after year number 10, from if you look at from year number 11, all these three columns will be the same because there are no surrender charges. You see 255, 255, 255.
right. After a while, they kind of get the same amount.
After
Okay.
year number 10, from year number 11, these three columns will be exactly the same.
Okay. And if you keep scrolling down,
Mhm.
The kind of annuity that I kind of came across and pretty much was not interested in. And this looks different unless I want to go. I need to go back and read and see what the difference is. If you would share this with Nari so we can all get it, or put
Absolutely.
it in a stock group so we can download it. The question that I had was the impression that I had with the
Mhm.
annuities is the amount that you commit,
Mhm.
and at some point, if the person were to die,
Mhm.
you lose the value because you would have gotten paid along the way. So basically, it's an actuarial information there that also gets folded in as part into the algorithm along with the interest rate that they want to pay, which is about 3, 4, 5% anyway, not more than that. So longer a person is alive, at least let's say 98 or something, the amount will still keep coming in, partially because you left the base amount, which is accruing the interest, but also there's a actuarial calculation that kicks in to the benefit of the person. So the actual value will keep increasing. But at some point, if the person were to die, that's the end of it. The only monthly payments or yearly payments that you get, but there's no other value the person gets. So in your example, at 75, sounds like either you get yearly payments if you're still alive or nothing.
You're right. But what I'm trying to say is, you're absolutely right. But what I'm trying to say is, think about how much you got by then.
Right. And that's interesting. The second part is you also mentioned that you could have a joint beneficiary. So
correct.
And that only is between husband and wife, not like not like heirs of the person. Correct?
You can
Only
do
the
if you have a major kid, yes, you can add them. If you have a minor kid, you cannot add them.
So could you go back and explain that?
So what I'm saying is, for a joint annuitant, the person you add must be your spouse or your kid. You can add your kid only if the kid is the major. You cannot add your kid if the kid is 10 years.
Okay. Some of us are lucky in that sense. Go ahead.
Yeah. So then what they do is they'll continue the payments for the joint annuitant.
Okay. For how long?
Yeah, that is still they expire. See here, I have they have illustrated till 95.
Okay. Because that sounds interesting in the sense if you add a major kid, becomes part of inheritance plan, and
oh, I know what you're saying. Okay, I got it. I think
okay.
they have a they have a ceiling of I think 100 or something. I think it depends on the insurance company. And now I get what you're asking. Yes, you're absolutely right. It cannot go if someone is there like 25 years and it cannot go till they are 100.
Right. Yeah, I was thinking there's got to be some cap, otherwise.
Yes,
Or
yes,
look,
absolutely.
the other way is if the value is there, it's not a real big deal for them to keep earning interest and keep paying the money because the overall accumulated value would have been $1 million by that time. By the time it's 75, right?
Yeah.
And keep earning interest and keep paying is it's not a big deal. If you, of course, they'll want to keep all the profit, but nonetheless, yeah, I would think there's some maximum
Yes.
number between the two.
I think
survivors.
I have seen some companies stop at 90, some companies stop at 100. So, but there is that max.
Okay.
And it will be what I have usually seen. It will be the greater of the two. Like for example, if wife is 90 and husband is 100, then it stops there.
Okay. Okay, great. So if you can share that information, so some this is for a weekend analysis. There are a lot of numbers to understand.
Yeah. So I think we're past the 1 hour. So what I will do is I'll leave my number. If any of you is interested in, there are many more permutations, combinations possible here. I just showed you an example. Like Athene itself has like about 10 different products, right? So there's like a pros and cons for each product. So it depends on your personal situation, right? So I gave a general overview so that people, there was a negative stigma about annuities. So my goal here was to kind of show you that there are different ways of there are different annuities, and you can still consider annuities as one of your investment product, not the only, but one of the products, right? So that's what I wanted to kind of do this session and bust some myths. So if any of you is interested in looking at any of the options for yourself and your personal situation, feel free to call me. I can give you a few options, take a look at it, and then we'll take it from there. And like I said, right, I mean, I'm not affiliated with any company, right? I'm just kind of looking at what is the best product for a particular situation.
Okay, thank you, Srini.
Yeah, and currently this company is Athene normally gives like about for the benefit base like 10 to 15%. I think now they were running a promotion where they're giving this for the next month.
One quick question.
Yeah.
This may be a dumb question, but still I will ask. Say, for example, I want to recommend this for my son and our daughter, whoever it is. Say he's only 30 years old, and he's going to put, taking this example, 120,000 now, and then it grows as the table says, of course, adjusted for when he invests and all those things. Now, again, say this is dumb question, don't laugh. So he puts 120,000, 100,000, whatever it is, and then he has to collect after he's 60. So let's say he doesn't want to collect until that. That is almost 30 years from now. Suppose he forgets that he even put this money. He moves, changes jobs, moves place to place, and all those things. He completely forgets. That happens to some people.
Yeah.
So what happens?
So, I mean, I'm thinking if he says he's forgetting, that means he's also not checking his email, because you'll get an yearly statement and performance report. So he's ignoring all that and then going. And then if he doesn't withdraw, puts in an explicit this thing to withdraw, it remains in his account.
Okay. So, okay, got it.
But then there are so many emails they're sending out, right?
Okay.
Yearly.
Okay, got it. Okay.
His wife will not forget.
Okay, any other questions, guys?
Thank you. Thank you for very useful information.
So I'll just put,
yeah.
This is the chat. I mean, I'm just going to put my number here and email. If anyone has any questions, feel free to call me. And like I said,
put it in WhatsApp, I think. We have that.
Yeah, so I just put it there, right? So,
yeah.
And then, like I said, I'm not going to recommend. I'm not going to recommend anything that I would not invest myself. So that's what